Hey everyone, welcome back to the channel. My name is Dan and I am a practicing whole of market mortgage advisor that offers fee-free advice to clients from across the UK. Remember, if you find my videos useful, feel free to subscribe to the channel and don't forget to use the link in my bio to book in a no obligation discovery call to see if I can help you. So if you're self-employed and thinking about buying a home, you're probably wondering, do I need to save more for a deposit than someone who is employed? I've helped hundreds of self-employed people across the UK get mortgages, sole traders, company directors, freelancers, you name it. And I can tell you now, being self-employed doesn't mean you're automatically penalised when it comes to the deposit. So let's get into it. The deposit requirements for self-employed applicants are actually very similar to those for employed applicants. In most cases, you'll need at least 5% of the property value as a deposit. That means if you're buying a £250,000 property, you're looking at £12,500 as a minimum. But, and here's where it gets interesting, if you can stretch to 10 or even 15%, you open the door to better mortgage rates, more lenders, and potentially higher loan to income multiples. Why? Because lenders see you as a lower risk when your loan to value is lower. The lower risk means you're likely to offer more favourable terms to you as their customer. Now, the real challenge for self-employed applicants isn't necessarily the deposit, it's the affordability assessment. So most lenders want to see 2 years of accounts or tax returns, but there are options with just 1 year if everything else stacks up. Lenders will assess your income based on net profit if you're a sole trader, or salary plus dividends if you're a limited company director, or sometimes salary plus your share of the net profit from the company. They want to be confident your income is stable and sustainable. So here's something that many people don't realise. A high deposit can also increase how much you can actually borrow from the lender. So some lenders apply more generous loan to income caps when your deposit is 10% or more. That means if you're scraping a 5% deposit, you may be limited to borrowing 4.5 times your income, but with 10 or 15%, you might be able to borrow 5% or even more with the right lender and the right circumstances. So does that mean you should wait to save more? Now, let's be honest, saving a bigger deposit can be a smart move, but waiting too long might mean you miss the boat. So house prices are usually on the rise, and if you're sitting on the sidelines trying to save up another 5 or 10%, you could find yourself priced out of market. Sometimes it's better to get on the ladder with a 5% deposit than to wait years for the perfect scenario. Timing the market is normally better than timing the market after all. So in summary, yes, you can absolutely get a mortgage as a self-employed applicant with just 5% deposit. But if you can stretch further, it can boost your options, increase your borrowing and save you money in the long run. So if you're still unsure where you stand, that's what I'm here for. So drop your questions in the comments or book a free discovery call using the link in my bio. Let's figure out your options together. Thanks for watching and I'll see you in the next one.